What do you do when you borrow something of immense value and promise to return it by a strict deadline, but as that date looms closer, the item has completely vanished from the face of the earth? This is the exact nightmare keeping Wall Street risk managers awake in their cold sweat right now, and the clock is ticking louder with every passing second. On the night of December 24th, while most of the world was focused on family and festivities, the silver market experienced a violent seismic shift. Silver prices exploded to $72 an ounce in a vertical spike that caught almost every professional trader off guard. The mainstream financial media was quick to dismiss this as mere holiday volatility or thin trading volumes during the break, but they are not telling you the truth. This was not random market noise. This was a forced liquidation. This was the sound of massive global banks with their backs against the wall, desperately trying to close positions they can no longer afford to hold because of a deadline racing toward them like a high-speed freight train. Imagine you borrowed your neighbor's car in October and promised to return it by mid-January, but now it is late December and every single car of that make and model has suddenly disappeared from the market. The dealerships are empty. The used car lots have nothing. And your neighbor is knocking on your door expecting their vehicle back in less than 3 weeks. What do? That is the precise situation sitting on the desk of the world's largest financial institutions. Except instead of a car, they are on the hook for millions of ounces of physical silver that simply does not exist in the open market. The $72 spike was just the first tremor. The real earthquake is scheduled for January. To understand why the banking system is currently surrendering, we have to look at the massive trap involving J.P. Morgan Chase. According to official lease agreements filed back in October, J.P. Morgan entered into what appeared to be a routine transaction. They leased a staggering 128.6 million ounces of physical silver from the Industrial and Commercial Bank of China, also known as ICBC. In a normal world, this is standard practice. You borrow the metal, pay a small interest rate, use it to cover short positions or supply industrial clients, and then you return it when the lease expires. But we no longer live in a normal world. The person J.P. Morgan borrowed from is not an understanding neighbor. It is the largest bank in the world, controlled by a nation currently in a high-stakes geopolitical standoff with the United States. ICBC wants their metal back in January. Not cash, not paper promises, but physical silver bars. Here is where the mathematics of the situation becomes impossible. According to the latest CME Group warehouse reports, the total amount of registered silver in the Comex vaults, which is the only metal actually available for delivery, sits at a pathetic 2.9 million ounces. Even if J.P. Morgan could somehow seize every single ounce available in the New York vaults, they would still be short by more than 125 million ounces. They are facing a contractual default against the most powerful bank in Asia. The $72 move on Christmas Eve was the result of risk managers realizing that they are out of time and out of options. They were forced to buy back their short positions at any price because the alternative is a systemic failure that could detonate the entire precious metals complex. If you want to find the smoking gun in this financial crime scene, you must look at the silver lease rates. These rates are the most honest indicators of stress in the banking system, and right now, they are screaming. Back in September, the cost to lease physical silver was a mere 0.25%. This low rate signaled a market of abundance where metal was easy to find and lenders were relaxed. However, the landscape shifted violently in December. Within a span of just 14 days, these lease rates exploded from 5% to an annualized 40%. Let that sink in. Major financial institutions are now willing to pay 40% interest just to borrow silver for a few weeks. This is not the behavior of a healthy market. This is the behavior of a desperate entity scrambling to find physical material that has effectively vanished from planet Earth. The London Bullion Market Association reports these rates daily, and the data confirms this is not a glitch. When a lease rate multiplies by 160 times in a month, it means the physical supply chain has snapped. The banks are paying these astronomical fees because failing to deliver the metal would mean a total loss of credibility and a breach of contract that could trigger cross-default clauses across their entire balance sheets. The 40% rate is the price of panic. It is the sound of a system that has run out of physical inventory while being buried under a mountain of paper promises. While Wall Street struggles with spreadsheets, the high seas are seeing a dangerous escalation that is directly feeding this silver squeeze. This is no longer just about trading, it is about geopolitical survival. On December 21st, The world watched as China redirected two Type 052D destroyers from their South Sea fleet toward the Atlantic Ocean. At the same time, Russian naval vessels, including the Admiral Gorshkov frigate, were detected conducting patrols in the Caribbean Sea, just 200 miles from the United States carrier group enforcing the blockade on Venezuela. For the first time since the Cuban Missile Crisis, warships from the three most powerful militaries on Earth are converging in the same waters. This is a direct response to the American interdiction of Venezuelan oil tankers. China depends on this oil to power its massive economy, and they have spent 20 years building this strategic partnership. By cutting off 700,000 barrels of oil per day, the United States has backed Beijing into a corner. China has responded by hitting the West where it hurts most, the strategic metal reserves. In early November, Chinese authorities quietly implemented export restrictions on silver. They are no longer letting their metal leave the country to bail out Western banks like J.P. Morgan. Furthermore, the Shanghai Futures Exchange has seen its inventories collapse by over 1,000 tons as the government secures supply for their own industrial needs. Beijing understands that silver is a vital component for modern warfare and green technology. By withholding the metal and demanding the return of their leased ounces, they are using silver as a financial weapon of mass destruction against the New York banking system. To confirm that this is a global crisis and not just a local anomaly, we must look at the physical movement of metal across the continents. The evidence is staggering. Between December 2nd and December 5th, the Comex registered silver inventories in the United States collapsed by 47.6 million ounces in only 4 trading days. This represents a 60% drop in the available supply that backs the entire paper silver market. This is not a gradual trend. This is institutional panic. At the same time, the situation in Asia is even more dire. The Shanghai Futures Exchange reported its lowest inventory levels in 21 months, with a 40% decline since October. This synchronized draining of both Western and Eastern vaults proves that the world is running out of physical silver at the exact same moment. But the ultimate smoking gun is a phenomenon called backwardation. On December 18th, silver entered backwardation by 60 cents per ounce. In a normal market, the price for delivery in the future is higher than the price today because of storage and interest costs. Backwardation means the market is so desperate for physical metal right now that they are willing to pay a massive premium for immediate delivery. According to historical data from the London Bullion Market Association, sustained backwardation in silver is extremely rare and almost always precedes a massive price explosion. The market is screaming that paper promises are no longer a substitute for the real metal. While the physical market is breaking, the underlying currency that prices silver is also in a state of decay. On December 18th, the Federal Reserve cut interest rates to a range of 4.25 to 4.5%. Chairman Powell called this a recalibration, but a closer look at the numbers reveals a much darker reality. The government claims inflation is running at 2.7%, but this figure is highly manipulated. If we use the same methodology that the Bureau of Labor Statistics used in 1980, real inflation is actually running between 7 and 10% annually. This means your real interest rate is not positive. It is actually negative 5%. Every day you hold cash or government bonds, you are losing 5% of your purchasing power. This is why institutional money is flooding into hard assets. We are approaching the first week of January, a period when $4 trillion in institutional assets are scheduled for portfolio rebalancing. These massive pension funds and sovereign wealth funds use algorithms that are programmed to shift capital away from losing assets into those that maintain value. When these systems calculate the impact of negative 5% real interest rates, they will trigger automatic buy orders for gold and silver. This wall of institutional money is about to hit a market where the vaults are already empty. The result will not be a slow rise in price, but a violent gap higher as trillions of dollars chase a handful of available ounces. The technical setup for silver as we enter January is unlike anything we have seen in the history of modern finance. By hitting $72, silver has effectively broken its all-time high set back in 1980 by the Hunt brothers. In the world of institutional trading, this is known as entering blue sky territory. Because the price has never been this high in the modern era, there are no historical resistance levels. There are no bags of old sell orders waiting at $75 or $80. This creates a vacuum that algorithmic trading systems are designed to exploit. These programs manage billions of dollars and are programmed to chase momentum. When silver moves into uncharted territory, these algorithms trigger massive buy orders automatically, creating a melt-up effect where the price accelerates exponentially because there are no willing sellers to stop the momentum. Adding fuel to this fire is the options market, which is now primed for a massive gamma squeeze. Thousands of call options with strike prices at $75 and $80 were sold by dealers who assumed those levels would never be reached. As silver gaps toward $80, these dealers are forced to buy physical silver futures to hedge their mounting losses. This forced buying pushes the price even higher, which forces more dealers to buy, creating a self-reinforcing feedback loop. According to data from the CME Group, the open interest in these high strike calls is enormous. If the market gaps open on January 2nd, the hedging requirements alone could move silver by $10 in a single trading session. As we approach the reopening of the markets, we must prepare for 3 specific scenarios. The clock is ticking toward the JP Morgan delivery deadline, and the calendar does not care about market sentiment. Scenario 1 is the escalation gap. If the military confrontation in the Caribbean intensifies, or if China officially announces further naval escorts for their tankers, expect silver to gap open between $78 and $82 on January 2nd. This move will happen in the first minutes of trading as orders from Asia and Europe hit the New York exchange simultaneously. In this scenario, you will not have time to think. You are either already in the trade or you are chasing a moving target. Scenario 2 is the consolidation phase. If diplomatic tensions ease slightly, silver may trade sideways between $70 and $74. However, this is not a sign of weakness. Given the negative real interest rates and the depleted vaults, any consolidation is simply a temporary floor before the next leg higher in February when institutional rebalancing fully kicks in. Finally, we must discuss risk management. The only scenario that invalidates this bullish thesis is if silver breaks below $68 on extremely high volume. This is highly unlikely because of the Shanghai arbitrage. Right now, silver in China is trading at a $5 premium compared to New York. If New York prices drop to 68, Chinese traders will buy every available ounce to ship it east for a guaranteed profit. This creates an unbreakable floor under the market. We are standing at a unique crossroads where mathematics, geopolitics, and depleted inventories have aligned. The banking system has tried to suppress the price of silver for decades using paper contracts, but they have finally run out of the one thing they cannot print: physical metal. The reopening of the market in January will be a moment of truth for the entire global financial system.